Hi guys, it's Zhang again from Moolahwise.com, and in today's video I'll be answering the most frequently asked questions about Index Universal Life Insurance, also known as IUL. We'll be discussing a handful of frequently asked questions that we get all the time about IUL. Some questions include, how does IUL or Index Universal Life Insurance work? Again, when I say IUL, I just mean Index Universal Life Insurance, but we'll use the acronym IUL for short. Then we'll explain what are some of the pros and cons of owning a IUL. So let's get into it. So an IUL is just an Index Universal Life Insurance, and it's the latest of the cash value life insurance. One of the first questions we get about IUL is, when was Index Universal Life Insurance created? Index Universal Life, or UL, was created in the 1980, but the Index Universal Life version was created in the 1990s. And if you've been following my channel, you'll know that life insurance has two engines: one that eats your money, which we will call the cost of insurance, and one that grows your money, which we will call cash value. In an IUL, the engine that grows your money is Index. Let's watch a video of the 3 ways your money grows.
You can have a fixed, variable, or indexed rate of return. In a fixed rate of return, your money will grow at a fixed rate. So you can think of a bank savings account. Every year, the bank will give you a 0.3% interest rate. In a variable account, your money will grow depending on the market. It could be negative, it could be positive. You can think of it kind of like stock. For instance, it can go up and it can go down. You can get a high return, but also lose all of your money. It's unpredictable or volatile. Then there's an indexed rate of return, where your money will mirror an index in the market. So when the market goes up, your money will go up. But when the market is down, you'll get full protection against loss. So you lock in that rate and you never lose any money. When the market goes up again, your money will go up like a staircase. There's also a cap or maximum which can limit your growth. You can say that more growth comes with more risks. You'll have to find a sweet spot along the way.
Then I'll show you shortly what using an index strategy will look like with numbers, and I'll draw it out so you could understand the concept later on in this video. One thing I do want to point out is that the cash value growth of an IUL is not in an index mutual fund, but rather linked or mirrored to a index like the S&P 500, which means that your cash value is not actually in the market. In an index mutual fund, the insurance company just uses that rate that the index is linked to credit your interest for the cash value at that moment. It's just a myth or a misconception that a lot of agents get wrong. They think that an IUL is actually just inside of a index mutual fund, which is not true. So one of the features of an IUL is the floor and cap strategy. Please watch my other video on what is a floor and cap to get a better understanding of the floor and cap strategy. A floor is the minimum your cash value will get. So for instance, if the cap was at 0% and the S&P 500 goes negative, then your money is safe on the sidelines, earning a 0% rate of return. And wouldn't you agree with me that when the market is going down, it's better to have a 0 than a negative? Think 2008. And the maximum you can receive on your cash value growth is called a cap. So for instance, if the index you are linked to yields a 10%, 11%, 12%, then guess what? You'll get a 10%, 11%, or 12% on your cash value. But if the index that you're linked to is yielding higher than the cap, the insurance company gets to keep anything above the cap in exchange for protecting your money from going negative. So let's see what it looks like with a flooring cap applied to some numbers for an example. So let's see what it looks like with a floor and cap, and I'll show you what it looks like with a floor and cap for comparison. So in this example, let's say you had $100 to save, right? And at the end of year 1, the S&P 500 returns a 12%, right? And so that 12% is added to your initial amount, which brings your balance up to 112. Now let's say the following year the S&P yields a negative 5%. Then the negative 5% is applied to the total of 112, bringing down your total to 106. And then let's say in the next year, in year 3, the S&P 500 yield a return of 20%. The 20% is then added to the balance, which brings it to the new balance of 127.68. Now in the year 4, the S&P 500 yields a negative 10%, which will give you a balance of 114.84 at the end of 4 years. Now let's see what it looks like if we apply the floor of 0% and a cap of 12% to see what that looks like. So let's see what it looks like with the floor and cap in my second example. At the end of year 1, the index that you're linked to yielded a 12% return, which gave you a balance of 112. Right? And in year 2, the index you are linked to yielded a return of negative 5%. Since there's a floor protection, you'll earn 0% for that year. Hey, 0% is better than losing money, right? In year 3, the index that you're linked to yielded a 20% return. With the cap, you'll get a 12%. And in the year 4, the same example yielded a negative 10%, right? So the floor is protecting your money again from any losses. Since it's yielding a 0% return, your balance is 125.44. Now keep in mind that this example is just to illustrate the power of using a floor and cap and not actual real returns of the S&P 500. Additionally, these numbers do not include fees, costs, or charges. So would you rather have 114.84 without a floor and cap on this side, or would you rather have 125.44 after 4 years using a cap and floor strategy? Now that you've seen it with numbers, next I'll show you a floor and cap using a graph. So the red line represents your money without a floor and cap. It can go up or down at any time, kind of like a roller coaster. I like roller coaster, but not on my money. And now the green line represents your money with a floor and cap. So when it goes up, it goes up. When it goes down, your money is safe on the side. It goes flat. And when the market starts climbing back up, you climb up to a higher position. And you don't waste any time recouping from the loss. So as you can see, the green lines ends up at a higher position since you don't have to start from a lower position due to the floor protection. Would you rather have the red line or the green line? Now imagine what that would look like on your money if you never had a quote-unquote negative year. So the floor is actually protecting your money from any losses. I would think it's a pretty safe vehicle to save your money, which would lead me to my next question that I want to answer, which is, are Iul safe? And wouldn't you agree with me that with the floor protecting your money, it is pretty safe a safe place to put your money? With the floor and cap protecting your money from losses, I would say the Iul is a pretty safe vehicle because of this feature. Now let's talk about taxes when saving money in an Iul. We can't talk about retirement vehicles without talking about the tax implications on your money during retirement. The next question we want to answer is, are Iul tax free? So to remind everyone of the 3 buckets of taxes, as you can see, the Iul is in the tax-free bucket, which means that any growth is tax deferred, and then when you access the money, it is tax free. The next frequently asked question I want to answer is, index universal life insurance good for retirement? I think it is a great tool for retirement because of the following 3 reasons. Number 1, there's no RMD on your money because Uncle Sam already got his cut from the previous slide. When you put your money in, a RMD just means a required minimum distribution, where Uncle Sam forces you to start taking out income from your IRA/401k or retirement account, and if you don't take out the minimum required distribution, you'll owe 50% of the previous year amount to Uncle Sam in taxes. This is the way Uncle Sam forces you to take out an income, so you can't keep growing your money in a retirement account forever. The next reason why it's good for retirement is that you can still earn a double-digit return up to the cap, of course, but if your money is in a 401k or IRA, then it's subject to market volatility. Most financial institutions will tell you to take your money out of the market in your retirement age because you won't have the time to bounce back if the market takes a dip. But in an IUL, you can be, quote unquote, be in the market without actually being in the market, since an IUL isn't in the market, but rather linked or mirror an index of your choosing. Next, or the third reason why it's good for retirement, is that there's no taxes on distribution. This is important because if you need to take out $100,000 to live, then you could just take out $100,000 from your cash value without any taxes. However, in a 401k/IRA, you will have to take out more than $100,000 to end up with $100,000 in your hand, right? So for instance, if you want to take out $100,000 in a 401k and end up with $100,000, you would have to take out $130,000, depending on your tax bracket, of course, to end up with $100,000 in your hand. Ultimately, the more you take from your retirement account, the less it will last, right? So keep in mind that if you don't have to take out extra money to account for required taxes, your money will actually last longer. And in retirement, everyone fears of outliving their money. So don't let this happen to you and your loved ones, and save your money in a tax-free account. So based on the tax savings component alone, do you think it's a good tool for retirement? I think it's a great tool for retirement because the tax bill in retirement could be really high, and on top of that, it's in a time when we aren't working, so we need to protect our money from taxes even more. Additionally, we didn't even talk about the health benefits or living benefit rider that we could use with our IUL too. We only discussed the tax implications on an IUL, so we can make a equal comparison to, say, a 401k or an IRA or a retirement account only. So the first pro from owning a IUL is that there is zero risk, since your money has a floor protection. The next pro for owning an IUL is the floor protection. You can see in my previous slide that the floor protection makes a big difference on your money. Next is you can participate in the market without actually being in the market. The next pro is that you get to have tax-free loans and withdrawals. The next pro I want to discuss is that you can add a living benefit, or you can access this money before you die for health reasons. And then next pro of owning an IUL is there is a tax-free loan and tax-free withdrawals. A next pro is that it is flexible in its funding, meaning you could put more or less depending on your financial situation. And also you could also earn up to the cap, or in some cases a double-digit return with minimum risk. And then last is there is no RMD, or no required minimum distribution. Now that you know what the pros of owning a IUL is, next let's discuss some of the downside of owning a IUL. The first downside from owning a IUL is that you have to qualify, since it is a life insurance program and costs are related to your age, your health, your gender, etc. When I mean etc., I just mean your previous conditions or previous health conditions. And then the third downside is that you have to max fund this policy to see its true power. And when I say max fund, it just means to pay the maximum premium allowed per your allowable face value. There's no guarantees or dividends like whole life. Like I mentioned in my whole life video, if a company gives you a guarantee or dividend, since if it is a guarantee, they will give you it comes at a cost, right? And so that guarantee, since it comes at a cost, but that's in a whole life video, so you can watch my whole life video to understand more. And then the last downside of owning a IUL is that you may not qualify for all living benefit riders. Living benefit riders is one of those riders that you get to qualify for if you are healthy, but if you're not healthy, then you won't be able to qualify for it. Now that you understand the pros and cons of owning a IUL, let's summarize what we learned today. So why is IUL good? It is good because of the three following reasons. Number one, it accumulates tax-free, and you can access this money tax-free, right? And then when you die, it blossoms and grows. It goes to your heirs as a pile of tax-free money. So in conclusion, owning an IUL is a great product if you want to have a set it and forget it strategy to your savings. No other financial vehicles can do these three things. Most can only achieve one or two of these benefits. Since it is a universal program, the monthly amounts are flexible, meaning you can pay more or less depending on your financial situation. On the other hand, you have to max fund the IUL to truly see the power of owning a IUL. And lastly, it's a life insurance product, so you must qualify for it. If you think IUL is right for you and you have the questions about where to buy an IUL, please check out my video about where to buy an IUL, and it can point you in the direction of what to look for when you are shopping for an IUL provider. We have a mission of educating 1 million families on the importance of life insurance. If you're looking for a part-time or a full-time opportunity where you can work remotely, I can show you how to get licensed, appointed, and teach you the words so you too can start helping people with their life insurance needs on a part-time flexible basis. Reach out to me at info@moolahwise.com or learn more at moolahwise.com. And thanks for listening. Bye for now.